Could a doom loop crash the housing market? Bill Dudley, former president of the New York Fed, told Bloomberg the Fed intends to crash the stock market. So how will that affect housing? Hello, ladies and gentlemen. I hope you're all doing well. Welcome to the channel. Today we're going to cover remarks from Bill Dudley, former New York Fed president, as well as news from CNN Business and Forbes. There's so much information to unpack here. Thank you so much for tuning in. One caveat: I'm a Florida, Georgia real estate broker, not a financial advisor. All right, let's begin. Okay, let's review what a housing doom loop could look like. Higher mortgage rates have an inverse relationship with housing prices. If housing prices come down, this would provide less money for cash-out refinancing, therefore less money would flow into the stock market. Government deficit spending may come to a grinding halt due to inflation, and asset prices will continue to fall. As the Fed puts downward pressure onto the stock market, many baby boomers could potentially start to monetize their second homes, putting even further downward pressure on housing. Consequently, the result would be less purchasing power, thereby putting pressure on stocks and followed by further housing price declines, essentially creating a housing doom loop. Not thoroughly convinced that the Fed is after the stock and housing market? Let's go over this article from CNN Business. The stock market sell-off is exactly what the Fed wants, former New York Fed chief says. Turmoil on Wall Street is a feature, not a bug, of the Federal Reserve's fight against inflation, according to former New York Federal Reserve President Bill Dudley. What's happening right now is exactly what the Federal Reserve wants to happen, Dudley told CNN in an interview referring to the recent volatility in the financial markets. Turbulence on Wall Street has increased as investors worry about a potential recession and brace for a series of interest rate hikes from the Federal Reserve. The S&P 500 lost more than 13% of its value between January and April, making it the worst start to a year since 1939. They want a weaker stock market. They want higher bond yields, Dudley said. The stock market, I think, is finally catching on to that. Tech stocks have been hit especially hard lately. The Nasdaq is in a bear market, down more than 23% from its record high. Dudley said current Fed officials will be encouraged to see the market reacting because it makes their job easier. The less the market reacts to the Fed, the more the Fed has to do. The more the markets react, the less the Fed has to do, Dudley said. In other words, if financial conditions weren't already getting tougher, the Fed would have to telegraph even more dramatic steps. The Fed has to be pleased by the fact that the change in their monetary policy plans has started to affect bond and stock prices in a way that will make it easier for them to get control over an overheated economy, Dudley said. And it goes on to say, of course, Fed officials don't want to panic investors in a way that crashes the market. That could slow down the economy too much by dealing a blow to confidence among consumers and CEOs. That's why soft landings are so difficult to pull off, Dudley said. Investors have sharply increased their expectations for how high interest rates will have to go to get inflation under control. And yet, Dudley said Wall Street may need to adjust its forecasts even higher given the scale of the inflation problem. I think the market still probably is a little bit underpricing where the Fed is ultimately going to have to go in the second phase of monetary policy, Dudley said. I think they have to actually start to make monetary policy tight in 2023. I don't think the market fully understands that yet. So, the Fed wants a weaker stock market and higher bond yields. Bill Dudley, former New York Fed president, stated that the Fed must tighten financial conditions to slow the economy down, pushing up unemployment rates to keep inflation in check. If financial conditions do not cooperate with the Fed, they'll have to do even further tightening. The stock market is important because most Americans have their wealth exposed to it. In almost all previous examples, when the Fed tightened financial conditions to push up the unemployment rate, it has almost always resulted in a recession. Dudley stated Jay Powell is not telling the public how difficult a soft landing is to pull off. The Fed must create a reverse wealth effect. If your home and stock prices are down, you're less likely to spend into the economy, thereby putting downward pressure on inflation. Check out my previous video, Fed Will Break the Housing Market, Episode 18, to learn more about the reverse wealth effect. Continuing on. Bill Dudley is not alone in his thinking. Many of the most respected names in business have been coming forward about global recession risks. Jamie Dimon, Carl Icahn, and other market experts are sounding the alarm about a recession. Here's what they've all said. Carl Icahn, who has a net worth of nearly $16 billion, was among the first Wall Street titans to warn of the increased risks of a recession. The founder and chairman of the investing conglomerate Icahn Enterprises said in a March interview with CNBC that a recession or even worse could be in the cards for the U.S. economy as inflation eats away at consumers' paychecks. Scott Minerd, Guggenheim Partners' chief investment officer, said this week that investors should be prepared for a summer of pain that looks a lot like the collapse of the internet bubble. Wells Fargo CEO Charlie Scharf said this week there is no question the U.S. is heading for an economic downturn. I think it's going to be hard to avoid some kind of recession, Scharf said at the Wall Street Journal's Future of Everything Festival on Tuesday. On April 5th, Leon Cooperman added his name to the growing list of billionaire investors predicting a U.S. recession. The CEO of the investment firm Omega Advisors argued that the Federal Reserve was slow to act to cool rising inflation. As a result, the central bank will be forced to raise rates aggressively to ensure price stability, thereby causing a recession. JP Morgan Chase CEO Jamie Dimon first warned about the significantly increased odds of a recession in April, arguing the ongoing war in Ukraine, high inflation, and the Federal Reserve's hawkish monetary policy could combine to create serious economic pain for average Americans. Then in May, the CEO went a step further, arguing the Federal Reserve has only a 33% chance of ensuring a soft landing for the U.S. economy, in which inflation is tackled without instigating a recession. Dimon said there's a 66% chance that the U.S. will either end up in a mild recession or something even worse in a May 4th interview with Bloomberg. So, what do you think the likelihood is of a housing price doom loop? Let us know in the comments. Okay, so today's takeaway. Bill Dudley, former New York Fed president, stated that the Fed must tighten financial conditions to slow the economy down, pushing up unemployment rates to keep inflation in check. This would create a reverse wealth effect causing massive demand destruction. Some 81% of U.S. adults now believe there will be a recession as inflation remains near a 4-decade high and the Dow Jones continues to drop. And a growing list of top economists and Wall Street investors agree. As the Fed puts downward pressure onto the stock market, many baby boomers could potentially start to monetize their second homes, putting even further downward pressure on housing. Furthermore, as the baby boomer generation has the greatest amount of accumulative wealth, millennials will more than likely not have the financial means to absorb the influx of assets. And finally, the Fed's dual mandate to contain inflation and unemployment risks creating a housing doom loop of epic proportions, crashing the housing market. If you like this video, please consider subscribing to the channel and hit that like button. I'm a Florida, Georgia real estate broker, not a financial advisor. Thanks again, and we'll see you in the next video.